The volume of trading in stocks in 1940 was less than one-fifth of that in 1929. And the capital issue market, which maintains the flow of money into business enterprise, is just as dead as the stock market. New issues in 1940 were less than 10 of the 1929 figure. Main Street may be having a good time with the defense boom, but Wall Street, State Street, and other centers that represent finance and the speculative mood of capital look like deserted villages. These are facts of record, but that does not justify the widely held assumption that the financial depression will continue indefinitely. When the revival does begin, and the author believes that there will be a revival, it is equally certain that it will be regarded with complete skepticism for a long time. Now, the mere fact that a downtrend has persisted for a long time is not in itself a guarantee that it is about to reverse, but precedent plus certain straws in the wind does suggest that this is the case. After all, there is nothing basically new in the situation. Social and economic revolutions linked with wars have occurred before, but the spirit of enterprise has always lived. The rules of the game may be somewhat different, but it is quite impossible to visualize, borrowing a loosely used phrase, the end of capitalism. And assuming survival of the latter, capital activity cannot remain indefinitely dormant, since capitalism, which, if it means anything, means the active expression of the speculative instinct, simply cannot live forever in what amounts to a denial of its own nature. The tendency today, of course, is to ask, how can there be anything ahead but depression and misery when the world is bankrupting itself in an insensate conflict of nations which must end with all weak and exhausted? Tragic as the whole picture may be, compared with a peaceful world developing its knowledge as it might for the benefit of all, that is not a reason for pessimism as far as future speculative opportunities are concerned. Quite the opposite, in fact, for as the historian James Truslow Adams remarks in Building the British Empire about one part of the 18th century, the period of peace following the Great Wars had, as usual, inaugurated a great speculation. It was much like America in 1929. Wall Street has had its own depressions before. In both 1911 and 1912, the range of the Dow Jones Industrial and Rail averages, the rails then being higher than the industrials, was confined to 14 points, with a correspondingly low volume of trading. Money-making opportunities were almost entirely lacking from 1908 to 1915, a period midway between two great speculative eras. That which occurred during the latter part of the Roaring Twenties is fairly fresh in memory, but most people do not realize the extent of public stock market participation around the turn of the century. It was much less informed, but nonetheless extensive. The financial pages of New York and Boston newspapers in those days are entertaining reading for such advertisements as those offering to send upon a 10-a-month subscription, guaranteed special number 29. The more you carry, the more money you will make. As pointed out in connection with Moment's secondary trend rules in Section 2, the opportunities for profit were as great between 1897 and 1906 as from 1927 to 1933, since price changes were just about as sweeping in both periods. Those who think that today's conditions are entirely new and compare them only with the periods that they may have known as normal are neglecting the lessons of history. It is granted that a gradually evolving social consciousness has outlawed the ruthless exploitation and the potential acquisition of tremendous wealth overnight that characterized some other periods. But that is not the same thing as a complete wiping out of the opportunities for enterprise and profit. This country cannot afford to neglect the driving force of private capital indefinitely, and some of the plans being studied in Washington with the idea of offsetting what would be the normal letdown from intense productive activity are interesting in this respect. Thus, it has been proposed to tax in such a manner as to force capital to take its chances in new enterprise. A tremendous amount of capital has been held in liquid form because of the belief that the risks in its employment outweighed the potential profits, limited as the latter are by existing taxes. But if other taxes involved a greater penalty in remaining liquid, capital would be forced to venture out. The attitude of the New Deal toward Wall Street has become less punitive and more understanding than it was in 1933. At that time, it was answering a popular demand. Investors had suffered severely in the immediately preceding years, less through undisputed financial abuses than through uncontrollable economic forces, but attention naturally centered upon the former. And so the era of reform began. Like all such movements, it went perhaps to extremes, but the pendulum is swinging back to normal. Quite rightly, there will be no return to the 1929 sky-is-the-limit days of pool operation. The Securities and Exchange Commission will see to that. Through the same agency, more information will be available on securities and on what is going on in the market, but these things are highly desirable and should have come long before. However, the tendency is disappearing on the part of governmental representatives to regard all speculation as harmful per se. Many of the new dealers had had no practical experience with Wall Street and thought of the stock exchange purely as a gambling institution. One day you played for a rise, on the next for a fall, the fluctuations occurring without rhyme or reason. They did not realize that beneath the froth of surface price movements, a vital service in financing industry is performed. Emil Schramm, ex-government representative and president of the New York Stock Exchange since June 1941, actually defended stock speculation upon assumption of his new post as a market aid to the more conservative investor and an essential economic function, if risk capital is to go into new industry. But regardless of what the government attitude may be, those who think that dictatorship or a totalitarian regime destroys stock values should ponder the fact that in 1941, the German stock market was above its 1929 high, with representative issues selling at prices to yield an average of only 3.7. For that matter, even the twice-burned public of today does not desire that stock market speculation should be eliminated, for given the slightest excuse, the eagerness for profits is quite evident, as in the flocking to buy war babies in the latter part of 1939. Human nature reacts about the same as it did when it was tulip mania time in Holland. The French public, under German domination, has turned to wild speculation in postage and of French stocks in the early part of 1941. The London Economist said, "In Vichy France, the boom is a boom in industrial equities. The rise has been so great that the authorities have issued constant warnings against excessive bidding up of quotations. Inflation, yes, but that merely happens to be the motivating influence this time. The future probabilities for the stock market are important to the subject of this book, because no method is of any use unless the opportunity exists to use it, and that implies reasonably wide fluctuations in stock prices. Theoretically, it makes no difference what the direction of the trend may happen to be, although human nature being constituted as it is, all but a few realists prefer to make their money through rising prices rather than by selling short in falling markets. But the money made on paper in a rising market is converted into cash and kept by very few, which is merely inherent in the nature of things. It can never be any different, and outstanding speculative success for any one individual implies failure on the part of others. Thus it is quite a selfish affair, and it would be hypocritical to pretend otherwise. Whether they admit it or not, most people who have anything to do with stocks are seeking profits in the end. Unfortunately, most of them confuse the issue with various extraneous factors to the detriment of ultimate results. Application of such methods as those outlined in this book can lead anyone to profits in contrast with previous failure, but the great majority will continue to delude themselves with surface thinking. Indeed, any method universally followed would defeat its own purpose, but no method will ever be evolved sufficiently perfect to attract anything like a universal following. If everyone believed implicitly in the Tao theory, for instance, no one would be willing to sell at certain junctures, and there would be only buyers for non-existent offerings of stock. Or if all the smaller traders began to follow the implications of the odd lot indexes, the trends of which they now largely create, the same index trends would not appear, but would be reversed before what would otherwise be their normal completion. They might still remain valid, however, since it is possible that a market pattern would result different from that which would otherwise have occurred, and in relation to which the public would still be wrong. Or it might be said that, if successful, the present odd lot traders would make enough to graduate into the 100-share lot class, their place being taken by a formerly more wealthy group at whose expense they had profited. The exact processes in such a case are difficult to visualize precisely, but it is possible to be sure that the majority will never profit in the end simply because it is mathematically impossible for them to do so. Everyone may seem to make money, and does, on paper, during a cyclical upward trend, because the value of their holdings is increasing as quotations for the relatively small amount traded rise. But nowhere near the amount of those holdings could be sold at the higher prices, for there would simply not be enough new money to buy. In taking the stand that the future will see dynamic and advancing markets with, of course, corrective declines as well, the argument has so far relied on precedent and opinion. Nevertheless, as remarked earlier, there are some definite straws in the wind. On the whole, the methods discussed in this book are of little assistance with respect to future long-term trends, because they deal primarily with the immediate picture. Hood's group action, for example, has been holding the purchases made at the low in June 1940 for over a year as this is written, but could conceivably change within any 4-week period. There are, however, some interesting aspects of the odd lot indexes on a monthly basis and the natural rhythm methods. In May 1941, the monthly odd lot figures showed that a condition had come about which had previously been observed only at the major bear market bottoms of 1921, 1932, and 1938. That is, for several months, the public had been becoming more bearish as prices declined, instead of exhibiting the normal tendency to regard lower price levels as a more favorable buying opportunity. And as would be expected, the data on the personal trading of New York Stock Exchange members showed this group becoming more bullish. The implication was that the market was turning from a bear to a bull trend, although the duration of the latter could not be foretold. However, based on previous experience, it would be expected to be good for at least a year. While on this matter of who is doing what, it is worthwhile to know that the Securities and Exchange Commission reports about 5 weeks after the end of the monthly purchases and sales in individual stocks by the officers, directors, and large shareholders of the corporations represented. This information has been available since the end of 1935, and on the whole, it has shown persistent and fairly steady liquidation. A fact that has been seized upon by some as indicating that wise money, visualizing gradual attrition of corporate earning power, was selling out to the public. In the author's opinion, a more potent reason has been the tax laws forcing liquidity in large estates, even though New Deal pessimism has doubtless induced a certain amount of selling. Moreover, this selling has not been particularly astute on its timing. The pace of liquidation was about the same in late 1937 and early 1938, when the price level was low, as when the best-selling opportunity of a decade had existed a year before at much higher levels. In fact, some insider stock was sold that would have better been held. However, corporate officials are usually recognized as notoriously poor judges of the market price for their own stocks. As a rule, they are likely to become bearish too early in rising trends and bullish too soon in declining markets. In other words, they know the normal value of their own stocks, but fail to recognize that market prices often bear little relationship to theoretical worth. But whatever the reasons may have been for insider selling during the last few years, the point is that the spring of 1941 looked as if it might mark a reversal of the liquidating process. As this is written, the extent of the reversal is not yet sufficient to prove the case, but since every important change of trend must have a beginning somewhere, it is the fact of the change rather than its size which is of real importance. The natural rhythm methods do, of course, afford a long-term picture, the question being the extent to which credence can be placed in their forecast. However, to repeat what has been said before, their indicated pattern in recent years has been far more correct than just chance seems to account for, and R.N. Elliott's record, for example, is carefully documented with unimpeachable outside sources. For that reason, the rising trend of stock prices, definitely indicated for the coming years, is at least interesting. Edson Beers, who also works on the principles of what is known as dynamic symmetry, wrote in Barron's for May 19, 1941, "This is not a new bear market. Rather have we been seeing the winding up of the period of preparation prior to a new bull market. The Dow Jones Industrial Share level called for on the initial rise not far off is 165. After a sizable reaction, the market should then begin its real climb up to the 300 level. Incredible. Certainly 300 seems so in the light of the 116 prevailing when this statement appeared. But the 1935-1937 bull market seemed just as incredible when forecast in the former year by Beers, who also predicted the 1937 decline. In fact, a well-nigh universal disbelief that any important trend is possible is a prerequisite of the condition immediately preceding it, since otherwise prices would already be moving rapidly in that direction, as action was taken in anticipation of the event. The same elements of dynamic symmetry, which Beers believes apply to the patterns of stock price movements, are likewise the basis of Elliott's wave principle, see section R4, although Elliott says he made this discovery after empirically working out the principle. Only the framework of the latter was outlined earlier, because a complete treatment would require more space than it was possible to allot, but some explanation of dynamic symmetry can be given. Dynamic symmetry is a long-recognized law of natural design, seen, for example, in the proportions of the human figure, growing plants, and some other manifestations of nature. It is ordinarily used by artists, designers, and architects, and, as a matter of fact, goes back to the ancient Greeks and Egyptians. The law may be expressed mathematically in what is known as a logarithmic spiral by the summation series of numbers 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, etc., each term being the sum of the two preceding terms. Note how Elliott's recurrent rhythms of 5 waves and 3 waves build up the same way. So far, so good. It is at this point that a mental leap must be taken to accept the thesis of Elliott and Beers that the law applies not only to the physical construction or growth of living things in the universe, but also to the actions of mass man, the stock market being merely an expression or reflection of those actions. Thus, the law is regarded as applying to the price ranges and time cycles of the market. To illustrate time, Beers cites the important turning points since the June 1932 major bottom as follows, which may be better seen with reference to the frontispiece. Know of months from bottom 3, 5, 8, 13, 21, 34, 55, date, September 1932, November 1932, February 1933, July 1933, Mar 1934, à présent 1935, Jana 1937 Dow Jones Ind, average approx, high or low for month 81, 69, 50, 111, 106, 96, 183. Corroborating the Beers forecast quoted earlier, Elliott's long-term wave analysis in the spring of 1941 showed the market to be in the earlier phases of an important cyclical upward movement, which might well eventually reach the 300 level. It is true that one could not see clearly just why prices should rise to any such extent, but the why is always much clearer in retrospect than it is in looking forward. Besides, if such situations were clearly defined, they would be evident to a great many, and that can never be the case on the eve of any important trend. Looking even farther ahead, it has been shown that the speculative opportunities for capital after the war are likely to be more rather than less. Allowing for the immediate dislocations, peace is fundamentally bullish. There will be much to reconstruct, and although reconstruction is likely to embrace a rather long period of years, it is worth remembering from a shorter-term point of view that the end of World War I did not bring about any immediate collapse. In fact, no previous period in American financial history more pointedly accentuated the fallibility of human judgments and forecasts than was reflected in early 1919, when there were numerous forebodings of another depression lying ahead. The depression came, it is true, but considerably later than expected, and after its probability had been largely forgotten, while to everyone's amazement 1919 recorded one of the most extraordinary bull markets in stock exchange history. One reason, of course, was the inflation that sent stock prices, food prices, clothing and rents to fantastic levels. Then was created one of our first alphabetical designations, HCL, the high cost of living, and that is something we may hear of again, despite the hopes in Washington that inflation can be controlled. Viewed in that light, a level of 300 for the Dow Jones Industrial Average does not sound quite so fantastic. The 1940 level of corporate earnings would hardly even need to increase. Given a confidence in the future that would evaluate earnings in terms of prices at 15 to 1, and we have had such ratios instead of 5 to 1, stock prices would triple. Or given a fear of the future, i.e., fear of inflation, causing a desire to own things instead of dollars, the same thing would happen. Investors have had inflation dinned into their ears ever since the dollar was first devalued in 1933. There was no inflation, at least in the sense expected, and they became increasingly skeptical. But as in the old fable of the boy and the wolf, it was a foregone conclusion that when and if inflation actually caught, everyone would be inclined to disbelieve the actuality. In the early part of 1941, there were more signs of true inflation than at any time in over 20 years. But there was certainly no rush to exchange dollars for goods or stocks, as on the false alarms of 1933 and 1937. Whatever the reasons may appear to be in the future, the author believes it is far more logical to assume that there will be opportunity for profit in the coming years than to take a defeatist attitude on the whole subject. Indeed, all history indicates that the aftermath of the war will include a great reconstruction boom in Europe, a revival of international trade, and an inflationary movement nearly everywhere. This does not imply that stock prices will just be rising year after year. It only means that they will change, rising substantially at times and falling at others, but not just pursuing a monotonous trend toward lower levels in a gradual process of attrition because of Hitler and the New Deal, those two bêtises noires of the average investor in 1940. As long as there is movement, the opportunities for stock market profits will exist, and the methods discussed in this book are designed to take advantage of those opportunities. That is all one can hope to do, because the market cannot be made to behave as one might like to have it. The background may differ, or the character of the movement may not always be the same, but if any approach is soundly based upon some factor inherent in the nature of market price changes, it will continue to work just as well as it has in the past, come what may. References to more important methods discussed the Burlingame Plan. Warren Fudd, Burlingame, 53 State St. Boston, Mass. Calculations of buying power versus selling pressure. Lowry and Mills, 40 Wall St. New York, and Wives Letters of Contrary Opinion. Humphrey B. Neal, Saxton's River, Vermont. The Dow Theory Comment. Rhea, Greiner Co. Colorado Springs, Colin Hood's Group Action. Oakman Hood, 8 Fuller Road, Wellesley, Mass. Quinn's Divergence Curve, Investographs, Inquest, 31 Gibbs St. Rochester, N.Y. Skinner's Financial Accounting Method, Townsend Skinner Co. 41 East 57th St. New York, N.Y. The Wave Principle, Arton N. Elliott, 25 Broad St. New York, N.D.Y. The 10% Rule, Carlton Davenport, 864 Humphrey St. Swampscott, Mass. The Odd Lot Indexes, G.A. Drew, 210 Newbury St. Boston, Mass. General Technical Analysis, H.M. Gartley, 72 William St. Parker's Method, Richard K. Parker, 54 Pinckney St. Boston, Mass.